Hello everyone, Business Guru back. In much better shape than I was yesterday when I recorded my video. I probably should have waited until today, but I saw that I hadn't posted and I was eager to put some content up. But watching it, playing it back, I mean, I was so tired I looked drunk, and my hair was all over the place. But anyway, now I'm in much better shape. So I did want to recap a couple of things I said, and I want to expand. I wanted to do another video on your fiscal year end and business structure to give you some actual practical examples of scenarios that you could encounter from a tax planning point of view. So. Um, One of the things that I was unclear in my video yesterday, I kept saying 2 months or 3 months for Canadian controlled private corp taxes. Okay, the deadline for Canadian controlled private corporations is 3 months out from year end. 2 months is the deadline if you do not qualify for the small business exemption or the small business deduction. It's not an exemption. I'm getting fuzzy here with my terms because I haven't been in the profession now for 10 years. I've kept up. I have to. But I just sometimes I lose words. You know, maybe it's because I'm 55 this year too. It probably has something to do with it. The other thing I said in there was that you get the small business deduction on 300,000. That's not right. It's 5 now, if I remember correctly. So there are situations where you don't get the deductions. There's grinds for high income or high assets. But chances are people watching my channel are not going to have corporations that are subject to those things. Most businesses, as I've said, if you qualify as a corporation or you incorporate here, most of the people watching are going to be Canadian controlled private corps. But you should know that the definition of a CCPC is that it has to be controlled by Canadian residents. And so if you have, 51% non-resident ownership, if you get a business partner in the States and that person is the majority shareholder, you're not a CCPC. And you will be subject to the higher rate of tax, which in the federal rate for corporations is 38%. You get a 10% federal abatement, which takes it down to 28, and then you get the provincial tax rate. So overall, you wind up paying, I think the high rate of tax in a corp is about 44%. So it's fairly high. It's higher than the rate that would apply to a lot of personal income. Now, there is one concept, and I think I'm trying to remember if I introduced it yesterday or not, and that is the concept of integration. So in the Canadian tax system, we have designed it so that the tax that you would pay as a sole proprietor on $1 of income that you earn yourself overall will be exactly the same if you earn that income through a company and then you subsequently distribute that income to yourself either as a salary or a dividend. Now, integration is not perfect, though. So as tax rates shift, at which they do every year, as personal tax rates change and corporate tax rates change and provincial tax rates change, you can get small discrepancies that lead to very small tax advantages or small tax costs to running income through a corporation. And that leads to planning possibilities for accountants, and that's how they make a lot of their money, is doing corporate tax planning. But generally speaking, by and large, there's no difference to how much tax you pay overall in when you make your income through a corporation and you distribute it out to yourself versus if you make it directly. Where the difference comes in is the timing of the tax payments. And that matters from a wealth building standpoint because, like I said, compounding is a very important part of wealth creation. And the more income you get to keep and reinvest and defer tax on, the more you can compound and the more wealth you can build much faster. So there's a significant advantage to using a corporation if you believe that you are not going to have to take all the money out. And so it's important to be able to utilize that structure if you are planning on building a business like that, or you want to build a business that goes bigger than yourself, because you necessarily will want to reinvest income in the corporation. Now, I wanted to get into some practical examples of choosing year ends and how and the decision for corporate versus sole proprietor. So one of the things I didn't say in my video yesterday is that once you make a choice, you're not necessarily limited to that choice forever. So for example, you don't have to it's not an either or in the sense that if you operate as a sole proprietor, you can't later become a corporation. You absolutely can. And likewise, I mean, if you start a business in a company, you can go back to being a sole proprietor. It's a little bit messy and it has some tax consequences, but you can do it. So one of the things to consider when you're making your choice initially is also whether or not you are going to be making significant tax losses when you start the business up in the early years, and whether you have income from other sources that you're paying tax on. So as an example, let's suppose that you decide you work in an area and you decide, you know what, I want to quit my job and I want to go start a restaurant. So you work hard, you save your money, you max out your TFSA, your tax-free savings accounts, and you have an RRSP that you've been contributing to for years. And you don't really have a lot of other cash savings. You do have maybe some stocks and bonds, but most of your money is tied up in your RRSP. So you decide in order to start and open the restaurant, you're going to collapse your whole RRSP and you're going to take the money and you're going to use that to fund the startup costs of the restaurant. Okay, so if you collapse the RRSP, if you collapse the RRSP, you're gonna be paying. Let's just pick an amount. Let's say the RRSP is $100,000. So your tax on that is going to be probably about 35% overall. So you're going to have a tax bill of $35,000. Now the bank is going to take off. They usually they withhold about 10% of the of the amount. So they're going to take off 10. But that's still going to leave you at the end of the year with a nasty surprise of about $25,000 of tax owing. So what you want to do in this case, I mean, if you're starting a restaurant, chances are really good you're not going to break even in the first year, because you are going to spend a whole lot of money on restaurant equipment. You're going to be spending money on leasehold improvements to convert a space into a restaurant. You're going to have grand opening costs for the restaurant. You're going to have a lot of upfront expenses to get the restaurant set up, to train your staff, to ramp up the transaction systems, to get the accounting systems in place, to build your supplier relationships, to do a whole bunch of things that you're not going to have to do once you're an established restaurant. And all of that has a cost. And it's very, very unlikely that you're going to break even and cover all those costs in the first year. You're probably going to have significant losses. And so if you start the restaurant as a corporation, those losses are going to be trapped inside the corp. There's no way for you to take those losses and use them to reduce the income from the RRSP. So you're still going to have the $25,000 tax bill and a corporation that's got losses trapped in it. They're only going to be usable when the restaurant starts making money. And if you're having to shell out $25,000 to the government, while you're trying to get your restaurant off the ground, that could endanger your ability to do that. So it's one way to avoid this is you start the restaurant up as a sole proprietorship first. And so now what you're able to do is you're able to take those losses and offset them against the RRSP income. So that, maybe, let's say you've got, 30,000 in operating losses that year. Well, now, you've only got 70,000 of taxable income, and maybe the tax bill on 70 is 30, so maybe you're 21, minus the 10 that they already withheld, so now you only owe 11 grand. It's still money, but it's less than half of what it was. So, and then, you can operate it as a sole proprietorship until such time as you start actually making money. And then what you can do is there's special provisions in the Income Tax Act that will allow you to roll all of the assets, all the equipment, and all the furniture and all the cutlery and all the stuff that you're using into a corporation where you can then just carry on the business. Now, there are a couple of things that'll change because, and this has to do with business numbers and account registrations. So when you start a sole proprietorship, you're operating under your social insurance number. Okay, you do have to open a separate HST account if you anticipate that you're going to collect more than $30,000 in sales, which if you're running a restaurant, you absolutely will. And you're going to have a separate payroll account for your employees. And as a sole proprietor, you would register and open up separate accounts for those things. And each of those things will have a separate business number. And it'll be completely different from the other numbers. When you're running a corp, it's different because a corporation doesn't use social insurance numbers. It uses a business number that's a 9-digit number with a suffix. And the suffix refers to the program accounts that the account is for. So for example, your basic corporate filing account will be 9 digits, RC, usually 0001. It can be 0002, 3, 4 if the corporation has gone through amalgamations with other corporations or it's combined accounts at some point. But most accounts that are open for the first time, they always default to 1. And payroll will be your same business number, but instead of RC, it will be RP. And your HST account will be the same business number, but it will be RT instead of RC. So with a corporation, they have the same business number, the same basic number, but only thing that changes with their accounts is the suffix that follows it. So if you have a payroll number and an HST number, and you're operating as a sole proprietor and you become a corp, you're going to have to close those accounts and open up new ones in the corporation using the new business number. But that's not too difficult to do. That's fairly easy. And then, once you're operating as a corporation, you can start using tax planning, and you can choose a different year end, and you can have some of the benefits of tax deferral if your restaurant is making more than you need to fund your lifestyle. Now, your choice of year end, I'll use the same example, should be set to be 3 months behind the time when you expect your cash flows to be at their peak. So if you have your busiest time, if your restaurant's busiest, if it's a seasonal restaurant, and it's busy, say, during the tourist season, and it has its best month in, I don't know, let's say August, then you would select your year end to be May. So that, when your tax bill comes due, you're able to pay the tax. Now, one of the things with CRA and corporations is that if you are, if your tax bill for a year is more than $3,000, they will require you to pay tax installments going forward. So once they get you on installments, your choice of a year end becomes actually a lot less material, because you're having to prepay the taxes over 12 months anyhow. But, if you never quite get to the 3,000 and you just owe 2,500 a year, and that's still a lot of money for your business and it's still a big cost, then the choice of your year end does become actually an issue, because you don't want to pick it to be a month when you're going to be low and you're not going to have the money to pay it. So it does play a role. And I guess the last thing I want to talk about is, what if you get into a situation where you operate a business for a while, but because you didn't make a lot of money, or you got really busy, or you're not very organized, you don't file for several years. And then 3-4 years in, you've got to prepare 3 or 4 years of personal taxes. And so you never picked a year end. And then how do you deal with that in a way that minimizes late penalties and interest on late filed returns? Well, this is where you take advantage of the fact that your year end, when you first choose it, can be anywhere up to 53 weeks after the time you incorporated. So the way you deal with that is you make a spreadsheet where you calculate your income and expenses over the whole period that you're responsible for filing for, without any breaks in the year end. And you go and figure out the point at which your business started to make money. Where's the point where it begins to become taxable overall? Understanding that any losses you'd have would carry forward and be usable against the income. So in order to minimize late filing penalties, you want to push as much of the income as possible up as far as possible towards your current date, so that you can get yourself into a position, preferably, where you're filing your last return on time, and most of the income is actually reported in the current period. Or you've got enough losses from the prior periods that you have really almost no income in the periods that you're late for. Because even though there's a late filing penalty on a tax return, if the actual tax owing that year is 0, then there's no penalty. So what you would do is you would try to find a year end that's going to allow you to report losses in the earlier years, and it's going to shift your window of the income where you have income into either into the current year you're filing, or if you can, into the year that's not over yet, so that you can push as much of that off and not have it be late and deal with it later as you possibly can. And then whatever you're actually filing that's late either has no tax payable or it's got the lowest possible amounts, because you've got that flexibility. So sometimes the way to achieve that is by selecting a year end that's very, very short for the very first year, and then going outwards from there. Anyway, those are my examples for this video. Thanks for watching, and hang in there.